Markets could see a wait and see. Markets could take a wait and see approach. Okay, that's better. This week ahead of the virtual annual meeting of Fed officials in Jackson Hole, Wyoming. Let's bring in Kari Firestone, Chairman, CEO, and co-founder of Aureus Asset Management, as well as a CNBC contributor. Jackson Hole's one thing. What does that get ranked compared to the Delta variant in terms of concerns for you, Kari?
Not very high. I think that the Fed has had a very kind of accommodated but also thoughtful approach, and they're giving themselves a lot of flexibility. So we don't think the market expects there to be a lot of change in policy or direction. So, no, I don't think Jackson Hole is going to drive the market this week. People are watching it, but that's not the main concern. The main concern is the Delta variant and what's happening. Are we reopening or are we reclosing?
And that's not monolithic throughout the country either. I guess we have to think of it that way. What do you think? I mean, you're not obviously a epidemiologist, but are we closer to the end of this, which Dr. Gottlieb has been saying for a while, or are we closer? Is it the beginning of the end or the end of the beginning that we're seeing with Delta?
Yeah, well, yeah. Obviously, we have vaccines out there. We know how to make vaccines, how to address the virus, and one would assume that Moderna, Pfizer, and other companies with the technology can create vaccines that will address a variety of new variants that show up. So we think this is better news than where we were for sure in the spring of 2020. It's about how can we maintain the economic growth that we've seen in stellar form in the second quarter, 6.5% growth, and not detract from that to the point that we're in a stalemate. We're assuming that the economy keeps growing, but as we saw in the second quarter, earnings were great. Guidance was also excellent, and the market over the last 6 weeks has essentially been flat. So it wasn't enough. If we right now had very high expectations for the third quarter earnings, and because of Delta, we have some, on the margin slowdown and their supply chain disruptions, it could be that we move out a couple of months, 3 months, 4 months, and we're still flat. So that's part of why we think that the market is, in a sense, waiting, meandering. We're not getting a lot of direction. You're not seeing either big surge again in growth stocks, big surge in the reopening trade. There's a wait and see. It's healthcare that's been the best performing group over the last 6 weeks. Also, by the way, if you looked at the top 25 performers of the S&P recently, what you're going to find is there's healthcare names, but the majority of the names have under 50 billion in market cap, which sounds big, but it isn't. It means none of the big stocks are driving the market, and that shows a bit of a lack of conviction right now.
Yeah, you've mentioned the growth value sort of dynamic, and you think you need to do both because it just goes back and forth, and it neither has necessarily. I think growth is still favored to some extent or has won, but you think you need to have both.
Yeah, well, we do. If you look at the market year to date, it's interesting. Growth, value, large cap, small cap, they're all up between 16 and 18%, more or less. It's the gyrations. So if you have very biased portfolios in one direction or the other, you're going to be whipsawed around, and people get uncomfortable with that. We have I would say, a biased growth portfolio, but we own names like American Express, United Healthcare, Waste Connection. Those are good reopening plays. And then we own a lot of the, Facebook, Apple, Google, PayPal type names that will do well in any kind of economy, did great in 2020, but those are sustainable growth firms that have big moats and a lot of forward momentum wherever the economy goes. It's better, we think, to have that balance of both some growth and some reopening, which are often lower multiple stocks, or American Express, for example, booking lower multiple, but Facebook's not that high in multiple stock either right now.
You point out that some of the growth names you have built-in inflation protection. Is that because you're not sure about the transitory nature of what the Fed is claiming and others are claiming for what we're seeing?
What we don't know. What we do know is that there is some inflation. I mean, you're seeing inflation in a lot of parts of the economy, and it may be purely supply chain driven because of COVID. That is in factories or at loading docks, or just because of people not coming back to work. Therefore, we think if you have companies that have, for example, subscription models, Salesforce or Netflix, Peloton, even Microsoft, these all have built-in protection because they're subscription models. They can raise prices. If you look at firms who have what we would call a strong market, at Sherwin-Williams, the housing market is so strong they can pass on some of those costs in higher prices to customers. Or American Express, Visa, PayPal, they take a % of revenues. And if there is inflation and their merchants start to price higher, they're taking their %. So they're protected to that extent. And we think that's a good hedge, makes some sense in this kind of environment where we don't know for sure.